The silver market is in absolute turmoil, and what most analysts are telling you is only half the story. Just weeks ago, silver was soaring to multi-year highs, but now it's in a dramatic freefall, wiping out recent gains and leaving investors worldwide completely stunned. We're talking about one of the most severe declines in decades, and it's got everyone asking the same question. Is this just a market correction, or is something much deeper and more broken happening behind the scenes? So how did we get here? How did silver go from a massive rally to a total free fall? Until very recently, silver was on an incredible upward tear. Strong investor interest, a rush to safe haven assets, and a ton of speculative money pushed it way beyond its usual price range. Hopes for lower interest rates and persistent inflation fears were pouring gasoline on the fire. But then, everything flipped, almost overnight. One of the biggest and most overlooked reasons for this crash was a sudden hike in margin requirements for futures contracts. Exchanges like the CME Group basically told traders, you need to put up more cash to hold your positions. Many leveraged speculators who had bet big on silver rising simply couldn't afford it. They were forced to sell. This wasn't a choice. It was a forced liquidation. This created a domino effect, a cascade of selling that triggered algorithms and stop-loss orders, pushing prices down faster and further than fundamentals could ever explain. At the same time, the market's expectations for interest rates shifted dramatically. A new, more hawkish U.S. Federal Reserve Chair was nominated, someone expected to fight inflation aggressively. This sent the U.S. dollar soaring. And as you know, a stronger dollar makes precious metals like silver, which don't pay interest, far less attractive. Finally, we have to talk about the speculative bubble. The sharp rally had attracted a flood of hot money from retail traders, ETFs, and momentum funds. When the tide turned, the unwinding of these leveraged positions was incredibly fast and painful. Key technical support levels were broken, and once those floors gave way, pure panic took over. It was like a dam bursting with a flood of sell orders overwhelming the market. But here's what most headlines are missing. The full picture is way more complex than just a simple price drop. First, while paper markets are crashing, physical demand for silver is still incredibly strong in many parts of the world. In some Asian markets, physical coins and bars are trading at significant premiums over the spot price. This disconnect suggests that real-world supply and demand aren't nearly as weak as the paper prices would have you believe. This brings us to a crucial point, the huge difference between the paper market and the physical market. The paper-silver market, which consists of futures contracts and financial products, can behave very differently from the market for actual physical metal. A crash in the paper market can happen without a real collapse in physical demand. Traders can be forced to sell contracts due to margin calls, even if they never intended to take or make physical delivery. So, this price crash might reflect financial positioning and market mechanics more than it reflects true industrial demand or scarcity. And what's really interesting is that after the initial shock, some of the big silver ETFs have actually seen net inflows. Long-term investors are buying the dip. This suggests that a significant portion of the market sees these lower prices as a golden opportunity, not as a sign of long-term weakness. Plus, this crash wasn't uniform across the globe. While prices plunged on major exchanges, local and physical markets in different countries didn't always fall by the same amount. This just highlights how segmented and complex the global silver market really is. So why is silver always so much more volatile than gold? Well, there are a few reasons. The silver market is much smaller and has less liquidity than the gold market. This means that large buy or sell orders can have a much bigger impact on the price. There's also a higher rate of speculation in silver. And unlike gold, silver has significant industrial uses in electronics, solar panels, and electric vehicles. This means its demand can swing wildly with the health of the global economy. When you combine thinner liquidity with highly leveraged speculative positions, you get the perfect recipe for the kind of sharp, violent price swings we've just witnessed. So, what are most investors missing in all this? There's a big gap between what the average person thinks is happening and what sophisticated traders understand. A huge part of this crash was a technical unwinding, driven by shifts in trader positioning and new exchange rules, not a sudden downturn in the real economy. And let's be honest, major institutional players who had short positions reportedly made a fortune as prices fell, which shows you just how unevenly the pain and gains from this volatility have been distributed. But let me be clear, silver isn't dead, it's just resetting. Many analysts see this drop as a painful but necessary correction after a massive speculative bubble. Markets often need to clear out the weak hands and wash away the froth before they can build a new, stable foundation for future growth. For retail investors, the biggest lesson here isn't about trying to guess where the price goes next. It's about understanding how incredibly unpredictable and leveraged this market has become. High volatility means high risk. So what happens now? No one has a crystal ball, but here are the three most likely scenarios being discussed. First, we could see a period of range-bound volatility, where silver trades sideways for months as the market stabilizes and traders figure out what to do next. Second, some technical analysts believe we could see further downside. If another wave of selling pressure hits, the price could retest even lower support levels before it finally finds a bottom. And third, the long-term strength could resume. If physical demand, especially from industry and for safe haven purposes, remains strong, many believe silver could start moving upwards again once all this speculative excess is finally washed out. The recent silver crash is a textbook example of how paper markets can completely disconnect from physical fundamentals and how leverage can amplify market moves to an extreme degree. It's a stark reminder that markets aren't always rational, especially when fear, sentiment, and technical factors all collide at once. Whether silver rebounds, consolidates, or continues to fall, one thing is absolutely certain. This episode has shown us all just how fragile and interconnected our modern financial markets truly are. Hey everyone, welcome back to the channel. Just when you thought the silver market might be calming down, it threw another massive curveball. Prices have been on an absolute roller coaster, swinging wildly and leaving everyone from seasoned investors to new traders completely stunned. While the headlines are screaming about multi-% drops in just a few days, the real story, the stuff most people are ignoring, is hiding just beneath the surface. Today, we're diving deep into the powerful forces shaping this chaos. First up, let's talk about the silent force multiplier in today's markets. Algorithmic trading. These aren't just simple buy and sell programs anymore. We're talking about sophisticated automated systems that monitor price, volume, and news, executing thousands of trades in the blink of an eye. In the silver market, once key technical price levels were broken, these algorithms unleashed a tidal wave of selling. This triggered a cascade of stop-loss orders, which then triggered more selling, creating a brutal downward spiral. Some experts estimate that these systems now account for up to 60% of the trading volume in the most active silver contracts. Think about that. This means a few automated triggers can create gigantic price moves that have little to do with actual physical supply or demand. It's a new kind of volatility that traditional market models just can't predict. But the bots aren't the only players. Silver doesn't exist in a vacuum. It's deeply connected to global macro factors. Things like geopolitical tensions, currency fluctuations, and interest rate decisions from the US, Europe, and Asia all send ripples through the market. Recently, stronger than expected economic data from the United States gave the dollar a major boost. A stronger dollar makes silver more expensive for anyone buying with other currencies. Add in the growing fear of a potential interest rate hike, and you have a recipe for a sell-off. Investors started shifting their money out of non-yielding assets like silver and into dollar-based assets that could offer a return. This shift from big money managers added a massive amount of fuel to the selling fire. Now, let's look at the human element. The same retail traders who helped power the initial rally are now caught in a whirlwind of emotion. If you look at social media forums and trading apps, they are flooded with a mix of panic, bold predictions, and desperate advice. This wave of retail panic selling has been supercharged by leverage. Many traders weren't just buying silver, they were using borrowed money to amplify their bets. When the price started to fall, these leveraged positions turned what could have been a normal, healthy correction into a dramatic, painful plunge. We're hearing reports of retail investors liquidating their long-term holdings at a loss, even though silver is still trading well above its historical averages. This just goes to show how powerful sentiment and emotion can be in driving short-term market moves, often completely detached from fundamental value. So why does this particular crash feel so different? Silver has had its ups and downs before, but this event is unique for a few reasons. First is the sheer speed of the decline. We saw double-digit percentage drops in a matter of days. That's faster and more brutal than many traders were prepared for. Second is the impact of leverage. Forced liquidations and margin calls from brokers poured gasoline on the fire, making the sell-off appear far more severe than the underlying economic signals would suggest. And third, this was a truly global event. From New York to London to Tokyo, investors across multiple time zones reacted almost simultaneously, creating a global chain reaction that fed on itself. Analysts are calling it a perfect storm, a toxic mix of high leverage, algorithmic selling, retail panic, and macroeconomic pressure all converging at the same time to create this extreme volatility. But even in the midst of all this chaos and fear, some traders are starting to see hidden opportunities. For long-term believers in silver, the sharp drop has created discounted entry points. If you have a long time horizon, these lower prices could be a chance to accumulate the metal at levels that looked impossible just a few weeks ago. There's also potential for arbitrage. The price difference between paper silver, like futures and ETFs, and physical silver, like coins and bars, can sometimes widen during these events, creating opportunities for savvy investors. And, of course, for highly experienced traders, the extreme volatility itself is an opportunity. Using options or other short-term strategies, they can try to profit from the wild swings. But let me be crystal clear. These opportunities come with incredibly high risk. Right now, the silver market is one of the most unpredictable assets on the planet. As you can imagine, market analysts are all over the place with their predictions. On the bearish side, some believe the price could fall further if more leveraged positions are forced to unwind and the macroeconomic headwinds continue. In the neutral camp, others think the market might stabilize and trade within a wide range as institutions and traders figure out where the new floor is. And then you have the bulls. The optimistic analysts believe this was a temporary panic, and that silver will bounce back as physical demand, especially from industrial sectors, provides a strong base of support. The truth is, no one has a crystal ball, and in a market moving this fast, a forecast made yesterday can be completely irrelevant today. So, what are the key takeaways for you, the investor? First, expect more volatility. The silver market is not going to calm down overnight. It's more unpredictable now than it has been in decades. Second, do not chase the market. Making emotional decisions based on fear or greed during these massive swings is a quick way to lose money. Third, if you use leverage, monitor your margin requirements like a hawk. Leverage is a double-edged sword that can wipe you out in a flash. Fourth, keep an eye on physical demand. Data on industrial use and sales of coins and bars can give you a clue about the long-term underlying support for the price, even when the paper market is going crazy. And finally, diversify. Given the extreme risk, your exposure to silver should be a balanced part of a wider portfolio, not your only bet. Ultimately, this silver crash is more than just a story about a precious metal. It's a fascinating window into the complex, interconnected, and high-speed nature of our modern financial system. The forces we've talked about today, leverage, algorithms, global participation, and social media-driven sentiment, are shaping all markets in ways we're only just beginning to understand. Investors who take the time to learn about these powerful dynamics will be far better equipped to navigate the turbulence than those who just look at price charts and headlines. Despite the chaos, silver remains an important asset. As an inflation hedge, an essential industrial commodity, and a vehicle for speculation, how it recovers from here, whether it's a slow grind or a series of sudden bursts, will be a captivating story to watch. Silver has been on a wild ride, and if you're like me, you're asking one simple question. What happens next? After these insane price swings, it's easy to feel lost. But don't worry, today we're breaking down exactly what could be on the horizon for silver and how you can prepare so you're not just reacting, but acting with a plan. Let's be clear, silver doesn't exist in a vacuum. Its price is a tangled web of global economics, big money bets, industrial needs, and pure human emotion. So let's explore the three most likely scenarios that could play out. First up, scenario 1. Stabilization. Imagine a boxer after a tough round catching their breath. That's what this could look like for silver. After all the chaos, the market might just settle into a trading range. We could see support forming around the $72 to $75 mark, where long-term buyers see value. On the flip side, any attempt to rally might hit a ceiling near $85 to $88 as traders cautiously test the waters. Volatility won't disappear, but it'll be less about dramatic crashes or moonshots and more about choppy, sideways action. This kind of market doesn't make flashy headlines, but it's a golden opportunity for patient investors to accumulate positions at a discount and for nimble swing traders to profit from the smaller waves. Now for the less cheerful outlook, scenario 2, another leg down. What could trigger this? A few things. If we see another wave of margin calls, it could force more leveraged traders to sell, creating a domino effect. Also, a persistently strong US dollar makes silver more expensive for buyers using other currencies, which can really dampen demand. And finally, if there are signs of a global manufacturing slowdown, the industrial demand for silver could weaken. In this case, we might see prices test lower support levels, perhaps around the $65 to $68 range. This scenario is a stark reminder of why risk management is non-negotiable. Chasing quick profits without a safety net can lead to serious pain. But let's not get too gloomy. There's also a very real possibility of a strong rebound. This is scenario 3. Optimists have some powerful arguments on their side. First, industrial demand is a massive anchor for silver. We're not just talking about jewelry. Silver is essential for solar panels, electric vehicle batteries, and all sorts of high-tech electronics. Even if the paper market gets shaky, the real-world need for physical silver provides a solid price floor. Then there's the classic safe haven appeal. When the economy looks uncertain, investors flock to precious metals. A new wave of buying from ETFs and big institutions could easily propel prices higher. And never underestimate the power of retail investors. We've seen how social media can drive buy-the-dip frenzies, and another one could absolutely reignite the rally. If these factors align, silver could not only recover its previous highs, but potentially soar past them. So, with all these possibilities, how do you navigate this chaos without losing your mind or your money? Silver is definitely not for the faint of heart right now, but a clear strategy makes all the difference. First, diversify. Don't go all in on silver. Spread your capital across different assets to balance your risk. Second, use stop losses. These are your best friends in a volatile market. They automatically sell your position if the price drops to a certain level, protecting you from catastrophic losses. Third, understand the difference between physical and paper silver. Holding physical coins or bars can be a great hedge against the wild swings you see in the futures market. Fourth, keep a close eye on the big picture. Macro indicators like interest rates, the strength of the dollar, and global economic reports have a huge impact on silver. And finally, the most important rule of all, do not make emotional decisions. Panic selling at the bottom and FOMO buying at the top are the fastest ways to destroy your portfolio. I want to take a moment to talk about something crucial that this recent volatility has taught us: the danger of leverage. Using borrowed money to amplify your trades or trading on margin sounds amazing when you're winning, but it magnifies losses just as quickly, if not more so. During extreme market swings, exchanges can change margin requirements without warning. This can trigger forced liquidations, selling your positions at the worst possible time, even if you still believe in silver's long-term potential. This is especially true for retail investors. The silver market is currently packed with highly leveraged players, and one small shift can cause massive overnight price swings. Be incredibly cautious here. It's also important to realize that what happens in the silver market doesn't stay in the silver market. This turbulence is a reflection of our interconnected global financial system. A crash in silver can drag down mining stocks, silver ETFs, and even related metals like gold and platinum. It also has a huge impact on currencies. A strong dollar, which pushes silver down, also affects emerging economies that rely on importing the metal for their industries. More than anything, extreme volatility in silver is often a canary in the coal mine for the broader market. It signals a deep-seated nervousness that can easily spill over into stocks and bonds. This makes silver not just an asset, but a powerful barometer of overall market sentiment. So, what are the key takeaways from all this? First, volatility is the new normal for silver. Predicting day-to-day moves is a fool's errand. Second, learn to distinguish between the paper market, which is driven by futures and speculation, and the physical market, which is driven by real-world supply and demand. The headlines often only tell one side of the story. Third, remember that industrial demand is silver's anchor. This fundamental use case provides a strong support base that speculative frenzies can't erase. Fourth, leverage can be deadly. The recent crash was amplified by forced selling from margin calls, and that risk is still very much present. But finally, and most importantly, opportunities exist for patient, strategic investors. Buying the dips or using smart hedging strategies can be very profitable if you do your homework. The recent silver crash is a perfect case study of modern markets where algorithms, retail sentiment, and global economics collide in a spectacular fashion. It highlights just how critical it is to understand not only the fundamentals of an asset, but also the mechanics of the market it trades in. For those willing to navigate this storm with caution and a solid strategy, there is real opportunity. The silver market has always been cyclical. History has shown us time and again that periods of extreme volatility are often followed by powerful recoveries. The key is to act with your head, not with your gut. Ultimately, silver remains a truly unique asset. It's a hedge against inflation, a critical industrial commodity, and a playground for speculators, all rolled into one. How this story unfolds in the coming months will not only shape portfolios, but could signal major trends for the entire global market. Thanks so much for watching. If you found this breakdown helpful, make sure to hit that like button and subscribe for more deep dives into the markets. Stay smart, stay safe, and I'll see you in the next video.